Doing a great job there. Thanks very much. Over to you, Georgie.
Thank you.
Thank you very much, Lisa. Well, yesterday's cut in official interest rates might be good news for home buyers, but could spell trouble for self-funded retirees. More than 1 million Australians have had their income cut by thousands of dollars because of a series of rate cuts over the past year.
Unfortunately, what's good for families with mortgages is not always good for every other part of Australia. But we've done things like increase the tax-free threshold, which helps a range of people, including low-income people.
Well, despite the downside for retirees, the big four banks are coming under mounting pressure to pass that rate cut on in full. Ross Greenwood joins us now. How much pressure, though, Ross? I mean, they're always going to put shareholders' interests first, aren't they?
Well, see, that's the interesting thing, because what the banks are saying, as we were saying before, is that they're saying because they've been overly generous towards retirees and people with money in the bank, that's raised their cost of funding, and that's their excuse for not having to pass these mortgage cuts on in full. Now, I sit there and say, well, hang on, if the banks have got their settings wrong, then surely, ultimately, the bank's shareholders should take some of the pain. But I'll tell you one thing, if you want to actually try and put the bank under pressure, then you've got to do it through competition. Now, the only way you can do that is to know what's in the marketplace, to be able to go back to your bank after these rate cuts or before and hammer your bank hard. Remember, ING Direct yesterday passed it on in full. It said, listen, our funding's better. Yeah. We've improved our funding. So that is the way in which you do it. Now, we're going to show it to you, because
let's have a look. Yeah.
If you can have a look at the top variable rates, if you right now are paying more than, let's call it 5.5%, you should be straight back to your bank and say, listen, if you don't, there's these options out there, e-money, loans.com.au. Notice they're all online, right? That's the important thing. But ING Direct out there yesterday cut their rates, so you can have a look at that, see where their rates are. Now, the whole point about this is where competition is. The standard variable rate for the big banks right now, before this cut, 6.6%. We're talking 1.2% here. I mean, really. So this is where the pressure lies. And if you want to put pressure on your bank, that's how you do it. Let's have a look at the fixed rate loans. These are even cheaper. And I think you've got to watch these pretty closely, because I think these could come down, in some cases, under 5%. And that is going to be very, very cheap money. You can lock in for 3 years and you don't have to think about what your rate's going to be. But you've got to expect that if rates continue to fall, these rates could go lower. So wherever you lock in, you've just got to turn a blind eye to whatever happens after that and be happy with the rate you pay.
So given that, would you be doing the cocktail loan? Would you be doing part fixed, part variable?
You could, but particularly if you're a new home buyer, I would certainly be locking in. Or if you've got a very large mortgage that you're worried about any rate increases in the future, again, that's where the fixed rate loans become more valuable to people. But that gives you some idea as to how to put pressure on your bank.
And do you think we're going to have another rate cut soon?
I think it'll come probably in the early or mid next year, but maybe not even one, but maybe even 2 more rate cuts.
Do you know why we love you?
Why's that?
You do the homework for us.
Well, there you go.
So
I've done a bit there.
Exactly.
So ring the bank. Ring the bank. It always helps.
Put your money where your mouth is.
There you go.
Well done. Thank you, Ross. Over to you, Lisa.
We needed Ross when we were at school, Georgie. OK, well, some good news this morning. A world-first study led by Australian researchers